Jobs data was a complete disaster. Or was it? Let's talk. Remember, coupon code expires tonight. We have the jobs data coming out in about 40 seconds, which is the perfect opportunity for me to mention that today is the final expiration, the final expiration of the coupon code. We're changing all of the marketing this weekend. If you're looking for the cheapest way to get lifetime access to all of the live streams, today is the day to upgrade to the Elite Hustlers course. It is the most inexpensive at the moment for limited time, and it gets you all the live stream accesses. So if you're a course member, you can bundle up as well. Email us if you need a custom bundle at kevin@beatkevin.com. And if you're not a member yet, it's the easiest way in to get lifetime access. It beats paying monthly. So do so before 11:59 Pacific time tonight. All of this will be changed this weekend. Here we go. Jobs data on deck. And it is unemployment rate 3.4. Oh my, what the hell? 517 change in non-farm payroll, 517,000. Average hourly earnings coming in at 0.3%. It's a match on the month over month, but year over year comes in at 4.4, slightly hot. How the hell did we add 517,000 jobs? The unemployment rate went down. It was supposed to tick up 0.1%. It went down to 3.4%. What the hell is happening? This is absolute insanity. 517,000 jobs. I'm not sure if this is like a massive seasonal adjustment or if I can't trust the Bureau of Labor Statistics at all. I mean, maybe that was my first mistake, is suggesting that there was even remotely hope that you could trust them. What the hell? 517,000 jobs? This is insane. I mean, unless there's a reason for this, like a disparity between households in the establishment survey, this is absolutely nuts. And this could potentially be just what we need for the market to plummet today. This is terrible news. What the hell is going on here? Total non-farm payroll rose by 517,000 jobs in January. The unemployment rate was little changed at 3.4%. Jobs growth was widespread jobs growth, led by leisure and hospitality, professional and business services, healthcare. Employment also increased in government, partially reflecting a return of workers from strikes. The household data was was both the unemployment rate at 3.4 million, the number of unemployed persons at 5.7 million, little changed, little net movement. This is quite bizarre here. See the note at the end of this news release for tables about information about the annual production, population adjustments to the household survey. Among major worker groups, the unemployment rate was 3.2% for adult men, women 3.1%, teenagers 10.3%, okay, blah, 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 blah. In January, participation rate was 62.4%, and the employment to population rate was 60, not changed. These were unchanged, okay, fine. Let's see here. Number of persons employed part-time for economic reasons, sitting at 4.1 million. Little changed. Not in the labor force was 5.3 million. Okay, little changed. Among those not in the labor force who wanted a job was 1.4 million. Changed little in January. This is the strongest jobs report, by the way, since July. Treasury yields are shooting up right now. The stock market's going down. You have a revision of more jobs in the prior months, added 71,000 jobs in the prior 2 months. The year-over-year number missed. This is absolutely insane. Everything's going red right now. This was my warning yesterday. Was all it was going to take was a miss on the jobs report, and you were going to have a poopsie-doopsie. This is a massive miss of 320,000 is the miss on this payroll number. This is insane. Non-farm payroll, 517,000 compared with an average monthly gain of 401,000. Leisure and hospitality added 128,000 jobs in January. The ADP report missed, by the way. Remember that. How are they counting this? Is this multi-job counting again? This is insane. Professional business services grew by 82,000. Government by 74,000. Healthcare by 58,000. Growth in ambulatory healthcare services. Retail trade grew by 30,000 in January. Construction added 25,000 jobs. Transportation and warehousing added 23,000. Social assistance added 21,000. Let's see. Average hourly earnings. Again, we saw the 0.3% and the 4.4 year over year. The 0.3 is stable, but the 0.4 was 1/10 higher than expected. Here we have the upward revisions of 34,000 and 37,000. That's not great. In accordance with annual practices, what is this here? The basis for industry classifications. Okay, revisions, fine. Total non-farm payroll. This is insane. Okay, let's look at the actual chart here because I don't know. Something seems off here. Let's listen for a moment to CNBC.
It is now. Maybe it's hard to read right this second in the futures.
Well, first of all, I got to mention how pathetic it was that I was the over, I think, and I was only half of the number. So I don't know if there's some statistical quirk in all of this, and I can tell you where the job growth was. One place for sure it was in leisure and hospitality. We've seen this, an industry struggling to get back to the pre-pandemic level, up 128,000. Government jobs also up strongly, 74,000. I'm not sure about the source of that. Take me a second on the B1 table here, everybody's favorite table. It looks like, state and government education, that was back big, up 34,000. Big part of that. Not on the federal side, more on the local and state side. You had construction jobs up 25,000, manufacturing up 19, retail up 30. If you're hearing a trend here, I can tell you what that trend is. The trend is that the job growth was broad-based. It was not in a single industry or a single sector. There were revisions to the upside in November, up 34,000. And Rick is right. New benchmarks on the for the year ending in March, up 568,000. So the job market was much stronger. You also lost one of the linchpins of those who thought the job market was slowing because the work week ticked up to 34.7. That was everybody said, oh, the work week's coming down. That's a sign of the weakening job market. That is gone.
This is insane. But look at this for a moment. This right here is the household survey, okay? Remember, the household survey is the survey that counts people who have a job. The payrolls, the establishment survey, the headline survey counts payrolls. So you can get double counted in a payroll, but you can't get double counted in the household data. But look at the household data. The civilian labor force increased from about 439,000 between November and December and 866,000 between December and January. And the number of those employed grew about 700,000 between November and December, and grew about another 700,000 between December and January. So they are actually suggesting 1.4 million more jobs here in the household survey, catching up to the establishment survey. This is crazy because initially there was this huge disparity between the payroll survey and the establishment survey, and there was this huge miss between the two. Now they're starting to catch up on the household number. This is quite strange. Tesla was positive before this data came out. It has now gone negative about 0.25%. Apple's down about 1.71. Google's down about 4. You've got the NASDAQ on this news dropping about 1.75%, and you got the S&P 500 down about 1%, at least in the pre-market on this news. Now, this could, in the weird way, this is a terrible report in terms of actually suggesting that the labor market is softening. But we need to put our Federal Reserve hat on for a moment, which basically is a tinfoil hat. So let's consider for a moment what this potentially means for the Federal Reserve. Okay, in the weirdest way, I want you to think about. It's not actually that weird, but I want you to think about, what did Jerome Powell say? What did Jerome Powell say? He said he was pleasantly surprised and delighted that inflation was plummeting without destroying jobs. And he actually hoped that could continue because it's a sign of a soft landing. Okay, all right. So the concern is a wage price spiral, right? Concern, wage price spiral. Well, average hourly earnings stayed at 0.3%, which is an annualized rate of 3.6% of an increase, right? So we didn't get a miss here. We did, to the downside. It didn't come in softer than expected. Year over year did come in a tiny little bit more than expected at 4.4. We were expecting 4.3. That's fine. That's not too terribly different from what we had. In fact, let me see here, 4.4. 4.4 is still a reduction from 4.6% in the last report, right? Okay, actually, sorry, the revision to that just came in. The last report was actually 5%. Holy crap. That was just revised to 5%. That literally just flashed on my screen as I said that. Okay, so this is actually really interesting. Okay, initially this seems terrible. Initially this is oh my God, where's Paul Volcker, right? But Jerome Powell told us it was actually a great thing that the risk of a wage price spiral was declining. And that is actually reiterated by this report. Year over year, wage inflation went from 5% to 4.4%. On top of that, we had the month over month hourly earnings stay stable at 3.6%. Now keep in mind, 3.6% is still higher than 2%. But when you factor in FATE or flexible average inflation targeting, it's actually not potentially that terrible. Like, that's okay. As long as inflation continues to come down, this could actually, in a weird way, be good news. Because remember what people are saying about the stock market. And no, it's not your reminder that today the coupon code expires. Link down below, February 3rd, 11:59 p.m. Last coupon code. We're getting away with coupon codes. No more coupon codes. Even though I have been getting a lot of comments from you, by the way. People are like, Kevin, first of all, we want to thank you for not having those annoying sponsors on the channel. And second of all, thank you for at least getting rid of the coupon codes, just so we don't have to hear about it anymore. There'll be something else, but it'll be a lot more limited in the future, and the best price is still going to be today, guaranteed. So anyway, in a weird way, this could actually be good news. Because remember what we think about the stock market, right? What do we think about the stock market? Well, you have two phases. There are two phases of a crash. Phase one is multiple compression. So multiple compression is basically what you're willing to pay for a stock coming down. So if you're willing to pay 10 times earnings, if it goes down to 5 times earnings, the stock goes down 50%. Multiple compression. Very simple. Okay. Phase two is EPS declines. Now, EPS declines are driven by less spending because people are getting fired or laid off or whatever, right? I think a layoff is just a nice way of saying fired. If someone says you're laid off, don't kid yourself. You got fired. Anyway, you were not valuable enough for the company. And that's depressing. And I think that's why they say layoff, so people don't get too depressed. But that's just the way it is. Anyway, so phase two is EPS declines. And yesterday, the biggest bear of all, actually, no, Michael Burry's like the biggest bear of all, and he deleted his Twitter account after he said sell, and then markets rallied. This guy, Macro Alf, whom I've kind of, I don't want to say complained about, but I've been challenging some of his charts, okay? I've been challenging some of his data. I actually tweeted at him. I never got a reply. It's fine. But I transparently tweeted at him, hey, dude, I'm trying to replicate your bear chart here, and I'm concerned y'all are trying to manipulate data. Let me just remind you of that really quick. I tweeted the following. Are the bears starting to manipulate data? My team and I were not able to replicate the bearish information presented in this chart. In other words, he's trying to say that like debt draws for spending are plummeting. But he pulled inflation off of this chart. That's what we believe. That's the only way he was able to do this, which you can't do that. You don't take a ratio of credit impulse and take inflation off of that. You can inflation adjust both of the inputs. Long story short, you can't inflation just adjust off of a ratio. That's like 0.25 minus 0.25 and changing like that, because you end up getting this funky chart that doesn't make sense. But we still can't replicate his chart. Because credit impulse data is not showing things as bad as his. And again, the only way we were able to replicate it was by pulling inflation off the way he does, which again, you don't do off of a ratio. Long story short, we weren't able to replicate this guy's bearish charts. Okay, so this guy's basically a bear every single day because he sells a newsletter because he has to be a bear every day. And that's okay. I'm okay with you selling insight and perspective. I actually think that's great. That's a fine thing. But I purposely hearted this so I could come back to it and find it. Just because I heart something doesn't mean I actually like it. But that's okay. And I support other perspectives. That's why I'm bringing them up. I'm not mad at Macro Alf. I'll have a beer with them. You know, I just have questions. That's all. Okay? Kevin just has questions. And so he says, the first innings of a recession always look like a soft landing. The labor market weakens, not enough to generate job losses. Earnings decline, but not negative year over year. Inflation drops, but not yet in a recessionary manner. Not yet in a recession until it is. And he basically goes into this argument that eventually, he's got this like 13 thing thread over here where he's like, look, eventually, people are going to get laid off. The jobs market is going to turn into a complete disaster and crisis. And when it does, earnings are going to go down for companies, and then you're going to have your real recession. Okay, that's a very fair rational explanation. Totally fair. But we have to understand a few things, okay? Number one bullshit guy. Number one most important thing is Jerome Powey. Jerome Powey just made it very clear that he's actually happy about a strong labor market as long as there's no wage price spiral. And guess what? We have things that tell us there's no wage price spiral. A, the Fed sees a lower risk of a wage price spiral. It could still pop up, and if you see it, it's too late, he says. But guess what else we see? We see that companies like Chipotle are finding it easier to hire and lowest turnover ever at Chipotle. This is great. Now, they are hiring like crazy, by the way. Hiring like crazy. Why? Because they're being a smart business. They're looking at the recession as an opportunity to expand, an opportunity to invest and end up taking more market share in the future. It's a smart company. There's a reason their stock trades the way it does, because they're a smart business with high margins. They know how to sell. Listen, if somebody told you you would get rich and become a billionaire off selling rice and beans, you'd be like, you're smoking crack. But guess what? That's exactly what Chipotle did. They became billionaires off of selling rice and beans. And they are damn good rice and beans. Quite wild. Anyway, so as long as there's no wage price spiral, right, that's important. So what did we get in terms of data? Fed sees lower risk of wage price spiral. Chipotle finds it's easier to hire. We're getting industrial layoffs like 3M and Dow, okay? That's actually usually a sign of kind of a bottom, and obviously we're getting tech layoffs. On top of that, what are you getting? Well, you're getting weaker than expected wage growth via the employment cost index. Now, we did get a higher JOLTS report, which means more job openings. And guess what Jerome Powell says? It's an indicator. In other words, Jerome Powell, he's being super blunt here. He's happy that we can grow jobs and see inflation plummet because it basically means no recession. This is the most predicted recession of all time. And what a middle finger it would be to every economist when it doesn't happen. This is actually, in a weird way, kind of good news. It's kind of crazy. But anyway, so you've got Jerome Powell. But what else do you have? Remember what you don't have if you have labor market growth. If you have labor market growth, what do you not have? Potentially those EPS declines. You actually have people who have more money who get to go out there and buy stuff again. And pretty much every earnings call that I'm reading in this earnings season is talking about how, what? The second half of the year is going to be glorious. Kind of believe it. Gary Black just tweeted, what recession? Yeah, no kidding. Somebody else replies, I don't know if he's a subscriber of mine or a subscriber of Gary's. I don't know. I only have like 10 subscribers on Twitter. Those are people who actually like pay to follow your super chats or whatever. I don't send any super chats. So thank you to the 10 people who are. But anyway, so probably a subscriber of Gary's. But anyway, but this allows the Fed to be more aggressive. Not necessarily. What I just broke down tells you that this is actually very characteristic of potentially a recession that does not happen. Now, don't get me wrong. The stock market's probably going to freak out today, okay? Probably not the best thing in the short term for the stock market. But long term, this is actually pretty good. Now, what's also very interesting is it buys me some more time to buy real estate. Yes, I kid you not. This strong jobs data gives me more time to buy the dip on real estate. Why? Well, it's obvious. Treasury yields just popped. Look at this. We went from being below 3.4% to being above 3.5% in a minute. An instant increase. In fact, I'd love to see the chart because it'll be really entertaining to just see that instant pop up. If we go to, let's go to like the 5-day over here, we should see the instant explosion in this. Oh, I screwed up the chart. I mean, whatever. You get it. You get the point. It's not even charted. Stupid CNBC. CNBC, you're sucking right now. The chart doesn't even show the 3.5 yet. What a ripoff. I'm trying to show off something cool, and they ruin it. Damn it, CNBC. Anyway, sorry. I'm sorry. I'm too angry this morning. But Zero Hedge is now tweeting that Michael Burry has officially reactivated his Twitter account. Oh, these guys are hilarious. Anyway, look, yes, short term. Let me summarize this like we're 5, okay? Short term, bad. Buy the dip opportunity though, and I know I say that a lot, but this is actually characteristic of a soft landing. And if you actually listen to what Jerome Powell says, this is actually potentially a good thing. Now again, I know that sounds crazy, because we've been waiting for bad data. But then when we get these terrible retail sales numbers, and I'm like, yay, terrible retail sales numbers, everybody's like, Gavin, you're pushing us into a recession. Everything's so terrible. Now the numbers are coming in good, and people are like, we need a terrible economy. It's like, you always get the opposite comments anyway, no matter what you say. It's just like opposite day in comments world. So I really limit my paying attention to comments. But I do pay attention to y'all, like Nighthawk here, who's saying Jerome Powell says, F your puts. But Andrew, I think you're right on with this idea about potentially another buy the dip opportunity. I was actually a little frustrated because I've still got like 14% cash that I'm wanting to deploy. And I'm like, dang it, the numbers are starting to run away. Like, give me some bad news here. But honestly, I don't think it's going to last long, because I kind of think the market's going to look at this and go, wait a minute. No inflation, yet jobs doing well? That sounds like a good normal economy to me. 2 sectors that underscore strength in hiring in the economy right now, manufacturing and construction. Gold fell below $1,900 an ounce. Gold is your recession indicator, right? See, that's the other thing. You look at recession indicators, and now what's happening? Now all of a sudden you're getting a plummet in gold. Look at this. This is IAU, which is not direct ownership of gold, but it's the easiest ownership of gold, in my opinion. I'm not pitching you gold, okay? I'm not shilling you gold, I promise. I'm just saying, if I was going to trade gold, which I've traded gold many times, if I was going to trade gold, I would probably just use IAU because I can trade it. I don't have to own the gold. I don't have to take delivery of the gold. I don't have to store the gold. I don't have enough guns to store gold. Maybe I don't even have any. Who knows? Anyway, so that's the gold's dropping on this. Let me see what else is going on in the world of Wall Street over here. Prime age participation rate is moving up. Look, more people getting jobs is actually good for the economy, right? Very good. The more people have jobs, the more people have money, and the more people have money, it's more people who could buy the brilliant courses on building your wealth with content that you can't find anywhere on the internet because it's awesome. Fresh perspective on actually becoming a millionaire in those programs. And yeah, we need people having money so they can invest in themselves and make the smart decisions. Year over year, we did have that average hourly earnings increase of 4.4%. And I understand that 4.4% year over year is slightly higher than what we were expecting, but it's worth putting that into perspective. I'm a big fan of putting things into perspective, okay? So let's go ahead and show you the chart of what that actually looks like. There you go. There's your earnings growth. Yes, year over year, it's still at 4.4. Annualized, it's still at a 3.6% rate. But look, it's plummeting. You know, we just had the last one come in at 5%, revised up to 5%. And so we just got our nice little plummet here. So let's, fingers crossed, that keeps going. I'm telling you, anything that's inflationary is going to be bad. Anything that suggests maybe we're not actually going into a recession should actually be good. However, this 3.4% unemployment rate is insane. This is the lowest unemployment rate we have seen since 1969. And remember, even the household survey showed a massive jump in earnings in job gains, by the way. So this is the strongest jobs report since July. It's the lowest unemployment rate since 1969. I don't even know that. What is that, like 50-something years ago? That's insane. So look, this is an incredible report. This is a bull market report. That's what this is. This is going back to a bull market era of the 2021 era almost, where we were gaining like, on average 500K jobs for probably the entire year. Again, this is going to lead to some temporary pain. It's actually leading Nordstrom to go up even more from 25% to 28%, probably again because people are going to have more money and they got to get those coupons in over at Nordstrom. Indices not happy though because the Nasdaq's down about 2% and SPY's down about 1%. Tesla's only down about 0.8 right now. Apple's only down about 1.8 after those earnings. And remember, this is on the back of crazy gains yesterday. Both of those were up over 3% yesterday. So we're really just kind of back to yesterday. Now, this is kind of odd. One that is plummeting is Amazon. Now, Amazon did have a 7% day yesterday, but it's down 6% in the pre-market right now. You are also interestingly seeing a decline on some of those more risk-based stocks like Affirm, down about 6% in the pre-market. Kind of interesting. About to go watch the real estate course in a minute, says Kyler. Kyler, love you. By the way, always remember, if there's anything you need me to add, although there's a lot of content, so I actually don't get that many requests to add stuff, hit me up in Discord. Just tag me. Hey, man, can we add something on this? I generally have my black screen operating every day, my black screen studio. It's at a different location than here. And I'm a big fan of recording on that black screen. It's great for lectures. Not so great for live streams like this. Anyway, that's the jobs report today for you. And wow, I mean, I'm gonna take my usual optimistic bias self and say this is great. But then again, I recognize my own biases, and so I mean, I don't know how you can see this as bad. The only way I think the Fed gets angry here is if the inflationary numbers start going bad again. So I don't know. We'll see. My thoughts on jobs.